Good afternoon, everyone, and welcome to our webinar today. I'm Erin Campbell, the Research Library Manager at the NAIC Center for Insurance Policy and Research. On behalf of CIPR and the Institute's Griffith Foundation, welcome to this next installment of our Back to Basics webinar series. The goal of this series is to take a look at the fundamentals of an issue in the insurance space to better inform public policy conversations in this area. Previous webinars in our series have covered insurance pricing, captives, fraud, and reinsurance. Recordings of all of these are available in our library catalog at library.naic.org. Today's expert speakers are Dr. Brad Carl of Florida State University, David Okasik of the Surplus Lines Association of Illinois, and Bree Wilson, Senior International Financial Analyst at the NAIC. Our Q&A segment will be moderated by Frank Tomasello of the Griffith Foundation. We'll be using the Q&A function for questions, and we'll try to get to as many as possible at the end of our session today. There will be a link in the chat for the program for today's session, and this includes bios for all of our speakers, CE certificate information, slides, and suggested further reading materials. The webinar is being recorded, and the recording will be available later on this week. Also, at the end of the session, I will provide a link for a very brief survey. We would appreciate your feedback on this webinar as we plan for future events. And now I will hand it over to Dr. Brad Carl to get us started.
Thank you so much. I appreciate the opportunity to be here. I've been asked in my part to just talk briefly about the basics of the surplus lines industry. So this is going to be very much a 40,000 level view, which I hope you find informative, especially if you've never been exposed to this surplus line industry before. So I always like to begin, as a good academic does, with a little bit of background. So we're all aware, hopefully sitting here, that the insurance industry is essentially in the business of assuming risk, right? Insurance companies assume risk. They pull losses in a way that allows average losses to be substituted for actual losses, right? So the goal at a very fundamental level for insurance companies is to, what we say, indemnify you, right? To restore you to the financial position you were just prior to the occurrence of a loss, okay? So if you look at what insurance companies want to do from the perspective of assuming and bearing risk, they want to do this not with all risks that are in the marketplace. They want to insure what we call ideally insurable risks, right? So that's this sort of loosely based, broad-based term that refers to some characteristics which insurance companies in what we call the standard market, or just insurance companies, sort of our normal insurance companies that we think about. These are the characteristics of the risk they like to insure. Again, typically this is not truly a sort of one or zero decision here, but anyway, in general, we see that insurance companies like large numbers of exposure units, accidental and unintentional losses, losses that can be determined and measured. No exposure to catastrophic losses, chance of loss can be easily calculated, and the ability to charge an economically feasible premium. What does that mean, right? What does that mean? It means that insurance companies favor certain risks, like I said earlier. So give an example. Give you an example here. Consider a house fire, right? If you sort of match up these ideally insurable characteristics with the house fire, you get this idea that house fires are what we call an ideally insurable risk. There's lots of homes. Losses are typically accidental, unintentional, with the exception of a case of arson. It's easy to determine, measure, and losses. There's typically not like the great house fire of New York City, right? There's not like a whole ton of houses burning down simultaneously, right? Again, with the exception of some wildfires. But loss can be calculated and premiums can be economically feasible. Contrast that with like a huge beachfront property or something, right? There's not a ton of exposure units. Losses might be accidental and unintentional, but they're difficult to determine and measure. They're catastrophic losses. So this is an example, this $150 million property beachfront exposure, where a loss may not be what we call, or risk may not be what we call ideally insurable, right? And so these risks that are not ideally insurable can be thought of a little bit deeper. They can be what we call distress risk, unique risk, large capacity risks, and emerging risk, right? So let's talk a little bit more detail about distress risk. So, an example might be a college bar or a poorly wired building. I can tell you in Tallahassee, there's a lot of the college bars here are distressed, right? So, but the idea here is that you have some potentially catastrophic losses, potentially indicative of intentional losses, and these might not conform to these rates being economically feasible, right? If you have some of these distress risks. You have other cases where you have risks that are not ideal because they're unique. So you think of something like musicians' vocal cords or a single event liability case, right? What you find is that some of these unique risks just don't have a lot of exposure units, right? So it's difficult to measure, determine to measure the loss as well. And sometimes it's difficult to figure out what the chance of loss might be as well. You also have this other non-ideal category, which is large capacity risk. So you think about something like a pollution liability for a power plant or large art collection. Not a whole lot of exposure units, potential for catastrophic losses. So again, this is not an ideally insurable characteristic. Things like emerging risks too are not ideally insurable. So I always think about an example where you have, let's say, a plumber that wants to start their own plumbing business and they want to get into commercial plumbing. They don't have any loss experience, so there's not a whole lot of information to be underwritten on, right? So you don't have, you could think of that as an emerging risk, that a plumber starting a new business, the standard insurance companies don't know what this new plumber's risk type is. But you can extend that to things like cyber liability or other like of these quote unquote emerging risks. These are difficult to determine, measure losses, and chance of losses aren't easily calculable. So when you see risks that sort of fit into one of these four categories, distress risk, unique risk, large capacity risk, emerging risk, these are risks that are typically ideal for what we call the surplus lines insurance market, okay? So what do we mean by the surplus lines insurance market? Well, we mean that these are companies that are not admitted. So you oftentimes see these terms, not admitted surplus lines, E&S, excess and surplus lines. You see those terms thrown around synonymously. And basically how it works is these are insurers that, again, are not licensed to operate in the states. Oftentimes you go and you get licensed to operate in one state, and then you act as a not admitted insurer in different states, right? So there is, some eligibility requirements to be a U.S. domiciled surplus lines insurer and also to be an alien insurer. But for the most part, the distinguishing characteristics of these surplus lines insurance companies are they are subject to very few regulations, okay? So I know some of my panelists will likely talk a little bit more about regulation, but I just might want to make a couple comments for for some context here real quick. The first comment is that as we look at the historical development of insurance regulation, we see that insurance evolved and remains to be regulated at the state level. So Paul versus Virginia was sort of this foundational case in 1869 that basically upheld the right for insurance to be regulated at the state level. If you hop up to U.S. versus Southeastern Underwriters Association, this reversed Paul versus Virginia, which was a problem. So very soon after, the McCarran-Ferguson Act was passed, and that ultimately returned regulation to state level, right? So first takeaway, insurance is regulated at the state level. The second takeaway, though, from this slide is that there's always been some historical development and discussion and consideration for these surplus lines insurers, right? That even as states recognized the need and the benefits for state level regulation as the development went on, they also recognized that there was a necessity for excess capacity, for excess and surplus lines insurers. And they recognize this, though, with the condition that, some caveats need to be made. And you see this in these New York laws, and the committees here. So this idea that, yes, you can allow these surplus lines insurers to have business for business to be placed with them, but they need to be placed with specialty agents and brokers, and they need to be placed by licensed professionals, and consumers need to be made aware that they are purchasing a surplus lines policy because of the fewer amounts of regulation, right? So the surplus lines has always been a distinct part of the regulatory process, but it's sort of over time been treated a little differently, okay? So what we see is that if you are a licensed, insurer operating in a state, you're heavily regulated, especially in areas like, personal lines insurance. The two particular areas I want to point out are rate regulations and form regulations. This is just that insurance companies are told, or regulated about their price levels, and they're regulated about what they can and can't say in terms of policy language. They have to seek approval in many cases, or keep it within a certain window from a price perspective, right? These regulations make insuring non-ideal risk difficult in the standard market. So the idea here is that if you go back to some of those distress risks or these other sort of non-ideally insurable risks to handle, part of the reason they're not ideal is because you can't price them accordingly, or you can't carve out moral hazard concerns, or so on and so forth. So this surplus line insurance market comes in as a secondary market here that is free from rate and form regulation. So this is sort of the distinguishing feature here. If you take nothing else from this presentation, take note of this, right? That these surplus lines insurers are generally free from rate and form regulations. What that means is they can charge what they want for risks that come across their desk, right? And they don't need to seek approval to modify policy language, right? So this provides a great deal of flexibility in insuring these risks that may not be ideal or desirable by these standard insurers operating in the marketplace. So I always like to just give a few examples here to contextualize what we're talking about here. I won't read all of these, but I think it's interesting. Keith Richards' fingers, right? Examples of risk insured by surplus lines. Something as mundane as a new contractor with no loss history. One of my favorite stories is there is a company that was getting started, and their whole premise was they were going to collect DNA from all the dogs in these huge neighborhoods. And then the idea would be if the dog went to the bathroom and the owner didn't clean it up, another neighbor could pick up the waste and box it up and send it into this company, and this company would use the DNA test to send the owner that didn't pick up their dog's waste a ticket, right? Now that was placed in the surplus lines insurance, in the surplus lines insurance market, because there's no loss history, right? Again, you sort of see all these lists, a single event liability, a huge museum battleship, these sort of unique risks, and the list goes on and on and on here, okay? So I just have a couple minutes left, and I just wanted to make a couple more comments to sort of set the stage for our next panelist. And the first is that in order to access the surplus lines insurance market, it requires a little bit of extra step. And let me tell you what I mean by this. You have an insurance buyer, so you think about the buyer of insurance as just the person that needs insurance, right? The new contractor, the company starting up the pet waste identification, right? Name the new business. They seek insurance. And they go to their retail producer, their agent and broker. And normally their agent or broker, if they had an exclusive agent, it would be a similar process, except they'd only go to one company. But the idea here is the agent or broker would go to these admitted insurers and obtain coverage, right, for this insurance buyer. But the problem is what happens if the retail broker can't find coverage from these admitted insurers? Well, that's when the retail producer can go to a surplus lines intermediary. So let me state something clearly here, and that is, there has to be evidence of a diligent search, right? That this retail producer here actually made an effort find companies to place the risk within this standard market, because the standard market is heavily regulated, and the idea would be it's better protection for consumers and access to a guarantee fund and things like that. So if they make a diligent search and they can't find coverage, or if the type of risk they're trying to place is on one of these export lists, which sort of list types of coverages that can be exported to the surplus lines market, you go to a surplus lines intermediary who then accesses the surplus lines insurance company. And I would be remiss if I did a summary of surplus lines and didn't at least touch on Lloyd's, which is a huge deal. If the insurance buyer needs access to the surplus lines industry in the form of a Lloyd's syndicate, it's a similar process. The buyer goes to the retail producer, the retail producer goes to the intermediary. Now the intermediary goes to Lloyd's brokers, and a Lloyd's broker goes to a Lloyd's syndicate. For those of you who are unaware, Lloyd's was originally sort of the foundation of insurance. It was originally a coffee house that was an insurance market. It's developed into a huge, massive insurance marketplace. And what you have is a situation where you have companies, investors, any sort of a wide variety of folks that can get involved in bearing risk in this marketplace and form these syndicates. And these syndicates, these Lloyd's syndicates, are a very important part of the surplus line industry. I grabbed some data from the III here for the years 2021 and for the year 2021. And in terms of the surplus lines premiums being written, you see that the Lloyd's market holds about 16% of the surplus lines market. And then you have it, and again, this is just in the, sort of looking at US premiums, and you have some of your other names, which most of you would recognize here, also participating in the surplus lines insurance marketplace. So with that, I believe I'm out of time. So I wouldn't, again, be a good academic if I didn't acknowledge my sources as well. So note that I relied on a bunch of sources here, and if you're interested in doing some more research, there's some great resources that I've listed here. So thank you for your attention. I appreciate it.
Professor Carl, we thank you for the exploration of the underpinnings and the mechanics of the surplus lines insurance market. Want to take just a moment to remind our audience that we'll devote the final 10 minutes or so of our session today to a Q&A segment. You may submit questions for our presenters via the WebEx Q&A feature, and we will review those incoming questions and do our best to address them as time permits. With that, it is a great pleasure to welcome to our microphones Mr. David Okasik, the CEO of the Surplus Line Association of Illinois. Mr. Okasik joined the association in 1991 and became CEO in 1998. He's responsible for the development and implementation of the overall strategic goals of the association, with a focus on technology, education, and regulatory affairs. He'll share his insight into current market challenges and opportunities with us. And with that, David, the floor is yours.
Thank you, Frank. I hope you can all see my screen. As Frank said, I'm going to be talking today about the surplus lines market as it stands today, the current surplus line market status, and we'll look at it through a few different lenses. We'll look at insurers, we'll look at producers, we'll look at premium volume, and then we're going to talk, as Brad did, a little bit about some of the risks and insureds that flow into the surplus line market these days. So as Brad touched upon, insurers are, with rare exceptions, not licensed in your state. There are about 15 states that have laws that permit a domestic surplus line insurer, but for the most part, you're going to have typically limited regulatory reach with surplus line insurers. They are, however, as you mentioned, licensed in their jurisdiction where they are domiciled. I would be remiss if I didn't mention throughout most of the 20th century, surplus lines had a really bad reputation. It was the Wild West of the insurance marketplace. If you were a bad actor back then, you were far more likely to set up shop in the surplus lines market because there were fewer regulatory touches. Even when I started at the association in 1991, there were at least monthly regulatory actions by the Illinois Department of Insurance against insurers and producers who were questionable or downright fraudulent. But that has changed pretty drastically over the past few decades, which I hope to demonstrate now. So insurers with top tier ratings. I'm going to talk first about a category I'll call the domestic professional surplus line insurers who write 50% or more of their premium on a surplus line basis. 99% of those have ratings of excellent or above. 99% of the domestic professional surplus line segment. If you look at the P&C industry overall, only about 84% have those top tier ratings. So the surplus line marketplace today compares pretty favorably with not only the P&C industry overall, but where we stood just a few short decades ago. What insurers are writing surplus lines? 74% of the premium in surplus lines comes through that domestic professional surplus line segment. As Brad showed on one of his slides, these are insurers who are in groups with names that you recognize, like Berkshire Hathaway, AIG, Markel, Fairfax, Berkeley, Nationwide, Chubb, Liberty Mutual, big names. Lloyd's has about 17% of the market. They are as Brad mentioned, the largest individual share. Regulated aliens are about 8% of the market. These are insurers who are not US based and are typically on the NAIC's quarterly listing of alien insurers, which is produced by the International Insurance Department, which I believe Bree is going to talk about some, and they do an excellent job vetting those insurers. And then about 1% is domestic specialty companies. These are companies based in the US who have less than 50% of their writings with surplus on the surplus lines side. Looking at solvency a little bit in the past decade or so, we have 176 admitted company impairments in that time period between 2010 and 2021. In that same time period, and the domestic professional surplus line side, one surplus lines company impairment. That was ReliMax in 2018. And if you want to find one before that, you have to go all 14 years back, all the way to 2003 was the previous surplus lines company impairment. Why has this been happening? Well, generally, these are very stable insurers. We mentioned these are with typically with large US-based insurance groups and companies like Lloyd's. They often have large capital reserves just waiting to be deployed in situations where a favorable opportunity pops up, some new insurance product, a hard market, things like that. Now, with these strong balance sheets also, and underwriting discipline that they've displayed, they tend to resist the market pressures that often lead to underpricing and questionable risk selection that are kind of the hallmarks of a soft market. So that's really helped them in terms of their impairment history. I will say, I may sound like I am advocating for surplus line insurers. In the spirit of the non-advocative mission of Griffith, I'm not doing that. I'm not saying they're so good that you don't need to regulate them. Kind of the opposite. I think the market is good because you regulate them. I think the regulation and the way regulation has developed and matured, especially over the second half of the 20th century and even more so over the last few decades, has really made the market into the strong player that it is today, the strong, safe, and reliable player that it is today. Talk a little bit about producers in the surplus line market. Brad gave you a little bit of a roadmap to that, but I will say that just demographically, if you look in your state, prior to 1999, when the Gramm-Leach-Bliley Act was passed, states generally didn't allow non-resident brokers, but Gramm-Leach-Bliley demanded of the states, it was a federal law, it demanded that they develop reciprocal or uniform licensing laws that allowed for non-resident brokers. And now we have at least 2/3 of our producers in Illinois as non-resident. About 80 to 85% of the premium flows through those wholesale brokers and MGAs that Brad talked about. About 15%, 10 to 15% comes from the retailers, where a retailer might also have a surplus line license, depending on how the states allow things to be structured. Many of them allow a retail producer to have a surplus line license, and the retailer doesn't have to go to another entity like a wholesaler or an MGA to access surplus line insurers, but are able to go directly. And then the remainder is either direct procurement from insurers or other market access points. If we look then a little bit at premium volume in the surplus line market, this is kind of an interesting story. I have a chart here now that shows for the past couple decades or so, the premium volume on the top line of the admitted market. You can see a couple of areas where there was a bit of a hard market. You see this bump about 99 to 2006 or so. And that admitted market went up about 56% during that period. Another hard market I'd say that we're in the middle of right now, but we have numbers for these purposes through 2021. About 2017 to 2021, the admitted market went up 20%. It's hard to see now on this red line at the bottom, the surplus line segment, how much of an impact there was on surplus lines based on this scope of a graph. But so let's zoom into that red line and look at just the surplus line market numbers. Over that same period, 1999 to 2006, when the admitted market went up about 56%, surplus line market went up 264.6%. That is a dramatic increase. In the 17 through 2021 time frame, when the admitted market went up about 20%, surplus lines went up 84%. These hard markets tend to affect surplus line dramatically for a couple of reasons, at least. First of all, they're getting more transactions in the surplus line market because during periods of soft market, Brad described what ideal and non-ideal risks were. In soft markets, there tends to be quite a bit of market competition, and the admitted marketplace is going to start nibbling away at the non-ideal risks that they probably shouldn't be dabbling in, but they're looking for some more market share, and they start taking these risks on. A hard market comes around, and risk selection becomes much more disciplined, and the admitted market starts letting go of these risks where they probably never fell into that ideal category, and the surplus line market is taking them back. Now, at the same time that you're having more risks, you're having more disciplined underwriting, so pricing is more ideal. You're more accurately pricing your risks, so prices tend to be going up, and transactions tend to be going up. For the surplus line market, that's a dramatic impact. In 2022, I have a survey of stamping office states, which represent about 60% of the marketplace in surplus lines, and they were up 24% for 2022. Through May, up another 7.5%. So this surge in surplus lines is still going on today, continues through today. And if we want to get some insight as to why this is happening and still continuing today, we can look at some of the risks and insureds that are in the surplus line market today and why they're there. Brad covered a good cross-section of the types of things that tend to flow in. I'll try and make sure I don't duplicate that and touch on some other things, but he talked about the types of risks that go to surplus line, the types that aren't ideal. And I'm going to take you through some of those same categories. New types of coverage, as he said, new, unusual, or unique classes of insureds, very large risks, he touched on that as well, and insureds with challenging risk characteristics, which is a nice way of saying, difficult risks. First, on the side of new types of coverage. Remember, surplus line insurers are the ones with sideline capital, nimble, creative underwriting, and they deploy that capital and talent when markets demand new coverages. Often after a period of time, the admitted companies will step in and begin offering those coverages once the dust is settled and they're able to see some claim and loss history and that they can base their products and their underwriting on. But it's always surplus line markets who come in first. One example would be drone coverage. In other words, the insureds are not different, but they're suddenly using this new technology, and it introduced different types of risks. This is a new coverage that the market had to come up with. There's no loss history, there's no claims history, there was nothing to look at. And surplus line insurers are the ones who are the more nimble, more creative ones. I heard a funny story. I had to look at my time. I heard a funny story of someone describing developing a new coverage on a surplus line risk. They said the underwriters would, develop something, use, ancillary data that they could come up with, pass it around, everyone would tweak it, then they bring it to the big boss, and the big boss would say, okay, let's write it, but first double the premium, because you had to account for the things you don't know that you don't know. And that's often how it goes. Sometimes it's that simple. But drones, kidnap and ransom coverage, that's another just, unique coverage that at one point somebody said, hey, my family or I or my employees are subject to this risk. Somebody please come up with a coverage for it. Surplus lines were the ones who did. Cyber coverage, we hear about this all the time now. Really, 1999, I believe, was the first cyber coverage policy out of AIG. It really only covered internet service providers and their third-party liability to their clients. But since then, it keeps evolving. Mid-market has stepped in a little bit and started to nibble at it, but the risk keeps evolving. The coverage keeps evolving in response. And so you see that since we started tracking it in Illinois, you can see it's, the amount of premium going on in the surplus line space continues to go up, and dramatically so recently. The push and pull between the hackers and the defenders in the cyberspace has been ongoing, and the nature of the risk and therefore the nature of the coverage continues to change. So the admitted market hasn't really been able to take this over. It's still in the surplus line market and still will be for the foreseeable future. Look at unique classes of insureds like transportation network companies. It's auto coverage. It's not a new coverage, but this is a different beast. They had to, surplus line companies were the ones who came in and developed the first coverages for those. Just other unique classes, rodeos, carnivals, amusement rides. These are the kind of things Brad also showed you examples of. Very large risks. I was looking through our database and I found a camping store chain where the risk had to be spread out over all those insurers, and a hospital system. The risk had to be all those insurers. Challenging risk characteristics, contractors, Brad covered most of these, nursing homes, vacant buildings, restaurants, explosives. All of these present unique challenging risk characteristics. And will this let up? I don't see that it will. Hurricanes, floods, droughts, wildfires, all of these, the severity and frequency seem to be increasing. The economic, political, criminal, civil unrest, supply chain uncertainties, I think all of these things lead people and companies to guard and protect their assets even more. Insurance is always going to be a part of that, and surplus line insurance will always be an important piece of that puzzle. And that's all I have. Thank you.
Oh, we thank you, David. Very thought-provoking presentation. Again, a reminder, folks, you may submit questions for our panelists using the WebEx Q&A feature. We've received a number of questions already. We'll continue to monitor incoming questions and devote some time here at the end of our segment to a bit of Q&A. With that, let us shift gears now for a look at surplus lines through a regulatory lens. And to guide us through that exploration, we have Ms. Bree Wilson, subject matter expert on surplus lines with the NAIC. Lots of ground to cover here, Bree. Where would you like to begin?
Thanks. I thought we would start out by just, again, highlighting some of the differences between admitted and non-admitted insurers. First, admitted insurers must have a license to in any state in which it wants to provide coverage, whereas non-admitted insurers or surplus lines insurers are not licensed in the state in which they're going to provide coverage. As Brad pointed out earlier, admitted insurers must comply with states' rate and form regulations and must seek approval and provide notice to state insurance departments on their policy forms and rates. And non-admitted insurers do not file these policy forms and rates with the state insurance departments. So again, they are said to be free from rate and form. Flexibility in accepting, designing, and pricing those unique risks that we see in the surplus lines market. And another key difference to note between an admitted and a non-admitted insurer is that admitted insurers pay into and have access to a state guarantees fund in the event of an insolvency, while a non-admitted insurer is not going to have that access to a state guarantee fund. So moving on, let's take a quick look at how a non-admitted insurer gains eligibility to begin writing business. And this is going to be defined through requirements that are established in the Non-Admitted and Reinsurance Reform Act, or the NRRA, and also in the NAIC's Non-Admitted Model Act, number 870. So the eligibility regarding domestic U.S. domestic insurers is going to be that an insurer must be authorized to write the type of coverage in its domiciliary state, and that it must meet the capital and surplus requirements of its state, or unless the home state has a higher capital requirement. Typically, this minimum capital and surplus requirement is going to be 15 million. There is an exception that allows a commissioner to approve a surplus lines insurer with less than a $15 million capital requirement. It can never be below 4.5 million, though. When we look at non-US insurers, the NAIC's International Insurance Department has been authorized to act on behalf of its member states. And with the support of the Surplus Lines Working Group, they provide the regulatory oversight for these non-US insurers. So the eligibility for these companies are going to be based off of the inclusion on the NAIC's quarterly listing of alien insurers. And the IID and the Surplus Lines Working Group have defined the minimum requirements for these insurers through its plan of operations. And this is going to state the following requirements for those insurers. There's going to be a minimum capital requirement of 50 million. The non-US insurers are going to be required to establish a US trust funds account, and that's going to need to be funded with at least 6.5 million, and that can go up to a max of 250 million. And the required trust fund amount is really going to be driven based on the company's annual surplus lines gross reserve amount. And the last thing that we look at is the key officers and directors of a company, and we are going to look at the biographic affidavit just to make sure that they meet any ethics and integrity standards. It is important to note that just because the surplus lines insurers are not licensed in the states in which they write coverage does not mean that the insurer, their transaction is not regulated. Because the regulatory states don't have control over the risks that are being exported, the regulation is usually focused on the actual transaction through the surplus lines broker. Because of this, the surplus lines broker must be licensed to sell surplus lines insurance business in the state it's placing coverage. And each state is going to have its own surplus lines laws, and these can be easily referenced in the Lock Lords manual, which I believe is included in the reading materials that you guys received today. But each surplus lines broker is going to be tasked with ensuring that an insurer is eligible to write coverage in the state, and it's also going to make sure it meets all the compliance with the requirements of the state lines or the state insurance laws when placing coverage. So since the non-admitted insurance is primarily regulated by the surplus lines broker, just quickly wanted to take a look at some of the requirements for licensure. So first, all surplus lines brokers must hold a property and casualty license. And this is just going to verify that they have sufficient knowledge of the products that they are selling. They also must pass a written test regarding the non-admitted market and any related policies and procedures. They are also required to pay a licensing fee to the state in which they obtain a license. And there are some states that require surplus lines brokers to be bonded to further protect the interest of the consumers. So now I thought we'd take a look at some of the more general regulatory requirements that are placed on the surplus lines brokers. States generally prohibit the non-admitted market from undercutting premiums of the admitted insurer in order to protect consumers. Again, risk should be placed within the non-admitted market, not to attain a more competitive rate, but because there's no appetite for it in the admitted market. So with that regard, one of the more significant regulatory requirements that surplus lines brokers must complete is a diligent search effort that Brad referenced earlier in his presentation. And again, this is just a good faith effort that there's been an effort to place coverage in the admitted market. And typically, brokers are going to submit an affidavit that the required number of declinations from the admitted market have been provided to give a good faith effort, to provide evidence of the good faith effort. There are two exceptions to the diligent search effort. One is that some states have eliminated this requirement so that they do not need to complete this to place surplus lines coverage. And secondly, there are export lists that vary state to state, but these lists provide documentation of certain types of coverage or risk that cannot generally be served by the admitted market. And so therefore, there's no need to complete the diligent search for those specific coverage and risk listed on the export list. Surplus lines brokers are also responsible for providing insureds with written notice that disclose a few different things. First, that the insurer is not licensed in this state and therefore is exempt to the same oversight as admitted insurer. And secondly, that the non-admitted insurance policy is not covered by the solvency protection of a state guarantee fund. A surplus lines broker is also required to report each surplus lines transaction to the appropriate regulatory authority. And this is going to be according to each state's specific reporting schedules. And the reason for this is to confirm that the placement of insurance was handled appropriately and reported correctly by the surplus lines broker. And lastly, surplus lines insurers are required to pay a premium tax based on its specific state surplus lines law. And the surplus lines broker is generally the one that is responsible for collecting that premium and remitting it to an insured's home state. I wanted to quickly cover state stamping offices. These aid in the regulatory efforts of the surplus lines. State stamping offices were formed by by surplus lines brokers as a form of self-regulation to facilitate compliance within the surplus lines regulatory environment. And the role of these offices is to facilitate consistency and encourage compliance. Now, some responsibilities that state stamping offices have is they review policy placements to ensure compliance with state laws and regulation. They compile premium data for statistical purposes, and they facilitate the timely and accurate remittance of state surplus lines tax premiums. And currently there are 15 different states that have stamping offices, and that is going to represent more than 2/3 of the US surplus lines premium. Next, I wanted to highlight the Surplus Lines Working Group and Surplus Lines Task Force role in the surplus lines. As I mentioned earlier, the working group drafts the IID Plan of Operation, which again defines the non-US insurers' eligibility requirements to write surplus lines. And the Surplus Lines Working Group also makes the final decision on the non-US insurers that are admitted to the quarterly listing. The Surplus Lines Task Force oversees the work of the Surplus Lines Working Group. They also review surplus lines industry trends. They provide a forum for discussion for current and emerging surplus lines related issues. And they are also going to develop or amend relevant NAIC model laws, regulations, or guidelines in regards to surplus lines. And lastly, to wrap up, I just wanted to provide a few NAIC resources that will give you some more information on surplus lines. I specifically would like to point out the NAIC Education Department offers a comprehensive surplus lines course on an annual basis, typically later in the year. And the IID is actually in the process of redesigning that course. We do have a specific regulatory module that will cover a lot of the same topics that I presented to you today in more depth. And we have partnered with state insurance regulators on that course to provide their perspective as well. And we've also added a few new modules to this course if you've taken in the past. We are incorporating a data module that will show trends of premium and profitability. And we also have Lloyd's presenting on a module talking about their specific role in the surplus lines market. And that I will turn it back over to the moderators.
Thank you very much, Bree, David, and Brad. We welcome you back as well. Appreciate you sharing your insights with us today. No doubt the presentations you've shared will help to inform some important public policy discussions. With the time that remains, let's focus on some Q&A. And to get things started, an attendee asks, if a surplus lines insurer makes changes to coverage and policy terms, must they provide timely notice to the insured or agent and broker? And more specifically, what might that time frame look like? So we want to toss that out for some color from you all, if you would, please.
Well, I can take a stab at that if you like, Frank. The laws vary from state to state in terms of what a surplus line insurer can or must do in a situation like that. Sometimes it falls under the cancellation and non-renewal provisions, and there are states where those provisions apply to surplus line insurers, and there are states where they don't. When they do, what's the time frame? Whatever is within the law. And that's a situation where I believe Bree mentioned that the Lock Lord manual, surplus line manual, is a good reference point for looking up what the rules are in those individual states.
Thank you, David. Bree, Brad, any additional color you care to share there?
I'd echo, my answer was going to be, state laws vary. So David gave a much more informed answer than I would have given.
Thank you very much. If you would, perhaps we could step back a pace or two, and I'd ask you all, if you would, to take a moment or two to distinguish surplus lines from captives. Care to compare and contrast there briefly?
Well, I'll take a quick stab and pass it along. I mean, I guess, I would view surplus lines as, totally exogenous, for lack of a better word. It's a totally outside the space, whereas captives, there's a little bit more ownership of the risk transfer from the person. Now I know there's complexities with captives and all that, but just from a 30,000-foot view, I would say they're distinct entities with distinct risk appetites and that those sorts of characteristics.
I would
Thank you,
agree, and add that very, very different, but there are some state laws where the captives fall under a similar legal requirements as like a direct procurement coverage. So there is a little bit of overlap in terms of the regulation, but I think Brad is quite right that they're very different animals.
Bree, anything to add there?
Yeah, I was going to agree. I think they both participate in the non-admitted market, but they are different from the surplus lines as they are more writing from the independently procured basis.
Appreciate your reactions and comments there. Do you see the increased volume of surplus lines premiums in recent years as a net positive consumers or net positive for consumers, or would you view that more as a net negative? We'd appreciate your thoughts there. Not sure who wants to lead off on that one.
I'll be happy to, if you like. I would have to come down on the side of overall a net positive. Surplus line market, the industry exists to cover the risks that the admitted market cannot or will not write. These insureds who are falling to the surplus line market otherwise would not typically be able to get coverage. So the surplus line market is stepping in as a safety valve. That's what we often call it. It's the safety valve of the insurance market, picking up these coverages where the insureds would otherwise go without coverage. Or they might end up in a residual market where the coverage they wouldn't be able to get the terms or the specific coverage options that they're looking for. So overall, I'd say it's a net positive. Some people think automatically surplus line premiums are going to be higher, and that's not always the case. Certainly it's the case sometimes, but because of the freedom from rate and form regulation, often they're able to put in exclusions that on the admitted market wouldn't be allowed. And so sometimes the price is actually more customized and lower than what they might otherwise be able to get from an admitted insurer if the admitted insurer was writing that. So overall, I'd say a net positive. Maybe some disagreements.
Yeah, no, I mean, I'd echo your sentiment, David. I think more capacity is better than less capacity, and so from my perspective, I mean, especially from my perspective down in Florida here, that's surplus lines market in various aspects down here is a key safety valve as we sort of navigate some of the challenges down here. And it's not just recently, it's, to your point, there's always a need for coverage. And I think that, on the net, it's not to say there's some instances where it's not, hurting consumers. But I think if the question is what's the net effect, I think from a overall net perspective, I think it's a benefit and it's positive for consumers.
Bree, do you concur? Anything to add there?
I think that it was very well said, and I am in agreement that, it's providing coverage that's important and is not offered elsewhere. And so I think I agree.
Appreciate your responses there. Bree, directing a question your way, you spoke a bit earlier about the sort of diligent search effort requirement, and also talked about a couple of exceptions to that effort. Can you provide maybe a bit of additional color regarding those exceptions? Are they in play in most jurisdictions, or what does the landscape look like there?
I will say that, so I referenced the Lock Lord manual that reference all the state insurance laws, and that does a very good job of detailing whether the diligent search effort is required for the law, and also if they have an export list. So I would definitely use that as a guide for that.
Thank you. Shifting gears a bit through the lens of surplus lines, where are we now with insurance of cannabis dispensaries and growers? Anyone care to touch upon that topic. I know we could probably talk for 60 minutes about that, and we're want for time, but I did want to work that question in for you all.
I would jump in and say that this is a prime example of a new class of insured jumping into the market and challenging risk characteristics, especially with regard to the fact that it's still a Schedule I narcotic federally. There have been efforts on the federal level, the Safe Banking Act, that would permit financial institutions and insurers to operate, give them some safeguards and guardrails within which they can operate legally with the cannabis market. But right now, it's kind of on a state-by-state level, and passage of that Safe Banking Act is far from certain at this point. Often these cannabis insurers, cannabis operations have to do business in cash, and the insurers have to make sure that they're working with within their own state laws and with banks within the state banking system that probably have certain exceptions for what's going on in those states where it's legal. And so it's a difficult emerging process right now.
Thank you, David. Bree, Brad, anything to add there?
I really don't have much to add. I think that was perfect.
Agree.
So stepping back a pace or two, I will ask you all, the three of you, if you will, here to gaze into your crystal balls, as it were. Looking ahead, what do you foresee in terms of potential changes in the surplus lines market over the next 3 to 5 years, if any? What might that evolution look like? I'm not sure who wants to kick off a response there.
Well, I can take a stab at, I guess, I know this is going to be the cop-out answer, right? But, to me, I think that there's always going to be new and emerging risks, whether that's dealing with risk coming from climate change, whether that's risk coming from, changes in, consumer behaviors or patterns or attitudes. And so, I think especially with, AI and with social media and all this kind of stuff sort of ramping up innovation, I just think the surplus lines industry is going to be key and going to thrive and flourish in helping to address some of these new risks that historically, insurers haven't been willing or even know how to write. So I know, again, that's the lazy answer, but I do think it's also the truthful answer that they're going to just continue to evolve and be a prime player in this market and serve as a great source of risk-bearing capacity for innovation.
Thank you, Brad. Bree, David, your thoughts?
I would say, if I had to answer truthfully right now, I would say a little more of the same, for sure. As Brad said, there's always going to be the need. The challenges are pretty clear. If I had to put my finger on some a risk for the surplus line market or headwinds for the surplus line market, it would be maybe, there have been efforts in the past at federal regulation of insurance, and so maybe in some optional federal charter, if that were ever to come up. A federal license would kind of eliminate surplus lines. There wouldn't be, I'm licensed in one state but not in others. I'd have a federal license, and if that were to evolve, there is the Federal Insurance Office. There was, I mentioned, the Gramm-Leach-Bliley Act. That's federal legislation that affected licensing. There is the Non-Admitted and Reinsurance Reform Act, which was part of Dodd-Frank in 2010, which imposed standards on surplus line insurer eligibility and which state can regulate and tax a surplus line risk. So the footprints of possible federal incursion into insurance regulation are out there. I don't see them going anywhere fast because I think the states hold on to state regulation of insurance quite dearly, and I think they make sure their federal regulators understand that.
Thank you, David. Bree, your thoughts as we look ahead here to the next 3 to 5 years and what the climate might look like?
I definitely agree with the new and emerging risk always being there. I know that we've also seen some just risk being moving back to the surplus lines market. A key one that we've seen is, states pulling out of wildfire coverage. We've seen a lot more applications for those types of that coverage. So I think that will play an important role in the upcoming years as well.
Well, it has been it really has been a fascinating conversation. We've covered a lot of territory in just 60 minutes, and we are now out of time. Um, so with that, on behalf of my friend and colleague Erin Campbell and her team at the NAIC's Center for Insurance Policy and Research, and all of us here at the Institute's Griffith Foundation, I extend a thanks to our panelists, to Dr. Brad Carl, Mr. David Okasik, and Ms. Bree Wilson for sharing their insights and expertise with us. We thank you all for attending as well. A quick reminder that a recording of this program will be available for complimentary and on-demand playback in the days ahead. Attendees and others will be able to access the program and/or links to it by visiting the websites of both the NAIC and the Institute's Griffith Foundation. Until next time, I'm Frank Tomasello of the Institute's Griffith Foundation, bidding you a pleasant good afternoon. And Erin, if you have any parting reminders or information, certainly we'd invite you to share those. If not, it has been a great pleasure.
Yep, would just remind everyone there is a link to a survey in the chat for feedback for this session. Thanks for joining, everyone.